So we're the Chester Group. I'm Brian.
I'm Patrick.
And I'm Hannah.
And I'm Tommy.
I'm Hannah, and Tommy's going to talk to us about the current status of round one after we acquired the company of the previous management team.
All right, first, we'll go over our leverage. All the companies had similar leverages in this round. As you can see, we have a leverage of 1.7 after round one. And from the balanced scorecard, to get full credit in leverage, you need a leverage of between 1.8 and 2.8, so we just missed the full credit there. We also led the industry in sales in round one with 52 million. We also had the second highest profits in round one with 3 million. We also have a contribution margin of 24.4% after round one, and that's due to our high labor costs. As of right now, we're still getting ourselves going. We can predict that in the future we'll have a higher contribution margin because we'll have a higher capital structure. And as we scroll down here slightly, you can see our market share after round one in the lower right hand corner, that we led the industry with 19% market share, which is something to take note of. As we scroll down, you can see that our stock price closed at about $15.50 per share, with us leading the industry in that segment as well as our market cap of $32 million.
So Patrick is going to talk about round 7 and how we improved from our last round.
Okay, our leverage is 1.9 into our operations, and it is now in the sweet spot range of 1.8 to 2.8. Our sales, we have $136.4 million, and we're leading in the industry right now. And our profit, we are not leading in the industry, but we are doing substantially well, being the second leading in our industry. And our contribution margin is now 53%, and that's due to limiting our variable costs and increasing our fixed costs. In the lower right, our market share has increased and we're still leading, and it's 22.09% as of right now. Our stock price right now is $84.66, and our market cap is 179.
Now Brian is going to discuss how we improved from round 1 to round 8 and give us an insight on how to become successful.
And I know off the start, we struggle with knowing exactly how to operate the company. It was kind of learning on the fly, so I'm gonna make this video to kind of help students, get over the fact and understand what to do next. So here we go. I just want to note here in the R&D, just make sure you station your products for the future, not the present, because it takes a year for products to develop. And then going on to marketing, there's just one category I want to talk about here, which is accounts receivable. This is just the number of days customers have to pay you back. It starts at 30, but I think through the time you should try to increase this to 45, 50, even 55, so it makes your product look better. And then for production, if you can, fully invest in the staffing and HR. This will have huge returns for employee turnover. And then just make sure off the bat to buy enough capacity to meet the demand, and invest in automation. This will cause for increases in your contribution margin and future profits. And then finance, I would recommend not paying a dividend till probably around 5. And the first couple of rounds, issue the max long-term debt so you can operate your new plan. And then for TQM, I would just fully invest right off the bat at $750,000 in each category, and this will help you reduce material cost, cycle time for developing new products, and demand increases. So there you go.
We earned 6.8 out of 9 for our profits. Our contribution margin was 5 out of 5, and we scored full credit in all of our TQM.
And then our profits were only 6.8 out of 9 due to the fact of investing for the future. Our contribution margin is 5 out of 5 because of our investment in automation. And then since we fully invested in every TQM category, we achieved full credit in all categories.
All right, now we're going to talk about our success measures that we chose for the project. This is just lays out how we view certain aspects of the business. As you can see, our cumulative profits, we've added that at 18%. Market share average of 20%. Average return on sales, 10%. Average asset turnover, 11%. Average return on assets, 1%. Average return on equity, 13%. Ending stock price, 18%. Ending market cap, 9%. And as you can see, we talked with a board member earlier and we kind of valued these at 18 and 9% here, but they're related to each other, so that was something that we should have noted before. But other than that, we did a pretty good job of balancing the respective categories.